Hi, my name is Nicholas Huggins, and today we are going to talk about the bare basics of the stock market. So let's get right to it. When companies decide to go public, they offer a certain amount of shares that you, the investor, could buy. These shares are set at a certain price, and whether, depending on if the company does well or poorly, the stock market price or the share price will rise or fall with that. Um, so, for example, Google and Apple, which way back when were their shares were not worth much at all, and now you know you see iPhones, you see all kinds of Apple products everywhere. Google is obviously a huge company, did really well. Their shares are now worth an extremely higher amount today than they were back then. And this is actually how investors make money. So the share price was really low back then, and now it's really high. So they could sell their shares for this price, and they only paid this much for it. So all this is profit. Okay, so now that's an example of good company though. You gotta beware that there are bad companies out there. A lot more companies fail than succeed. Google and Apple are they're two of the best examples of successful companies. But like I'm saying, there's a lot more that fail, so you got to be careful. And the way that investors and financial advisors try to get around that and try to earn their investors a steady profit, they insist that you invest in many different shares or many different companies' shares of stock. This way, if one company or a couple companies don't do so well, or maybe they stay steady, hopefully there's going to be a few companies that rise over time, and then your profit will come in a nice steady line, hopefully earning you more over time. Be careful with what you do. Learn a lot about the companies you're investing in, and have fun investing.